Hello, hope you're having a wonderful day. This is Josh Belk with the Belk on Business podcast. Last week we took a week away, talked with Manny in regards to branding, and hopefully if you missed that podcast, maybe go back. I think you'll find some value as we had a little bit of a conversation talking about branding as it relates to in your company and also you personally. In today's podcast, we're going to pick up where we left off a couple weeks ago, talking about financial metrics for different phases of the business. We started off talking about the startup phase, what we should look at when we're in that particular phase of the business, went into the next phase or stage, talking about in the growth phase. And what you'll see as you kind of work through these phases is pretty much the main metrics you're going to look at are going to change. It doesn't always necessarily mean you're going to leave those prior metrics behind, but I think many times you're going to add to them, but you're going to look at them at some of them more frequently, others at them, others of those metrics less frequently. And you'll also notice that there's a change in a focus of what metrics that you end up looking at. Very much at the beginning, you're really focused on cash flow. Then you move from cash flow to those top line revenue drivers. And then as you begin to move into the profit phase, you're going to, in this phase, begin to focus more on your profit percentages. And I'll talk a little bit about that as we work through this podcast today. Now, there are, of course, a lot of different terms that are used in these different phases or stages of the business. Sometimes you'll hear the profit phase called the maturity phase. In this particular phase, you'll have some out there that will talk about that it's just simply the business being profitable. The P&L shows a positive number. The one element that I see that's missing many times is looking over at the balance sheet and seeing whether or not investors are being paid back, and also bringing in the balance sheet side of the equation as well. I think true profitability in a company only comes when you're truly making a profit in the business, but also beginning to pay investors back. And I'll talk a little bit about that in a future podcast as we talk about moving from that profitability stage into scaling, into the scaling and legacy phases of business. So as we hop in today, going to not get into the weeds on as far as what should be or how should we define profit. But really kind of what we should be looking at when we're in this phase of the business and when our business has finally reached to the point to where it is profitable continuously. It doesn't mean you're showing profit in one month, but you have been showing it for a time. Some will mention, it needs to be 3 or more months. Some will say it may be a number of quarters. But you kind of know that your business is profitable. You have a model that is somewhat sustainable, something that you're able to continue on and you're not worrying about at this point reverting backwards. Okay, and I have 8 different, and they aren't all metrics, but they all are different areas that I think we can look at and we should monitor as it relates to making sure that we're succeeding in this phase and that we're eventually, if that is our goal, to move out of the profit phase into the next phase. First is we're going to continue to focus on our churn. We've talked about that actually both the prior 2 weeks, but also our retention rate. So our retention rate are essentially the customers that keep using a product or service over an extended period of time and make repeat purchases. Our businesses generally are only going to be successful and are only going to remain profitable if the customers keep coming back. A business that has to continue pursuing new customers is not going to remain in the profit phase on a long-term basis. Okay, so really be looking at that retention rate. Are the customers that we're reaching, are they coming back and purchasing from us again? Are we retaining those customers? And then depending on the type of business that you have, it may be a monthly recurring type of a metric that we may look at, or another different type of metric, but there's going to be something that we're going to look at to make a determination on whether or not our customers are returning. In my main business that I own is an accounting firm. We have some of our clients that we see annually. We have others that we see monthly, or we receive revenues from monthly. And so we'll have retention rates, but they'll be different depending on the type of business model or the type of service offering that we're providing for that particular client or that group of clients. And we want to see whether or not that we're retaining the client that we have. Some of them will only look at annually, others will look at monthly, others quarterly. So understanding your retention rate, and then also you're continuing to monitor that churn. But in this case here, we're looking at net negative churn. So essentially what net negative churn is the revenue gained is higher than the revenue lost as it relates to churn. So if we're looking at a monthly model that we have, so say we have an app, for example, and we're billing out monthly. So our new clients that are coming in that we're retaining is greater than the clients that drop off over time. You can kind of visualize that. Okay, so making sure that we're in a position of net negative churn. And if we're there and we're retaining our clients, so if our retention rate's going up, our net negative churn is in a position to where we're bringing in more revenue on a recurring end, whether that's monthly, quarterly, annually, is greater than what we're losing, we're going to maintain our profitability. And really we should be able to grow. Maybe not as quickly as the longer the business is in existence, but we are still growing and we are still able to remain profitable. Once those numbers of our retention rates continue to drop, if that net negative churn is one to where we're seeing more clients drop off than we see signing up and giving us revenue, then providing us revenue, eventually we are going to revert back into a prior stage or ultimately go out of business together. The second metric we're going to want to look at is that gross profit percentage. So I mentioned that in this phase we're going to look at the profit percentages. So gross profit percentage. What this is the revenues need to be growing at a higher percentage than the cost of producing the product or service. So that spread is growing. We did mention gross margin in a previous podcast, but that gross profit percentage is growing. So we're and this can come through a number of different ways. This can come through our top line revenue. We're growing that because we're increasing our prices. It can be a situation to where we're seeing that our cost to produce that product or service are decreasing. Whether that is through efficiency, whether that is we're able to purchase more at a bulk from maybe a supplier, so we can get a lower price point. But that we're seeing that spread continuing to increase. So that gross profit percentage is going up. Next is the operating profit percentage. So when we look at a gross profit percentage, we're looking at our gross revenues less essentially our cost of goods sold, or the cost that are related to producing that product or service. Then when we bring in our operating profit percentage, this is also going to bring in the admin or their operating expenses as well. So that is generally what a company will look at as it relates to the net profitability of a company. And I think ideally, if you're a little bit more of a sophisticated business owner, you're gonna really kind of focus on EBITDA. So your earnings before your interest, tax, depreciation, and amortization. That's going to be an extremely important number. And then you're going to look at your bottom line net profit, and you're going to monitor both of those. And that may be outside the scope of this podcast, but essentially, is that net profit, is your business, is the profitability growing over time? So after I paid all of my expenses, do I have some profit left over, and is that profit percentage growing? Next is going to be looking at owner's pay. And I have two previous podcasts that relates to what should I be paying myself as an owner. But in a profit phase, you need to be paying yourself a reasonable salary, and you also need to be paying yourself a salary that's covering your living expenses, and also doing the tax planning aspect of it as well. And so a business that is profitable, you do not have a profitable business if you cannot pay yourself as an owner. And you cannot pay yourself a salary or a wage as an owner that's a living wage, and is one that that essentially is equitable for the seats that you are sitting in the business. I have heard from time to time, my business is profitable, but I'm not able to pay myself. If that's the case, then your business is not profitable. Okay, at that point, you truly are in a prior stage. You are still in the startup phase, or you're still in that growth phase. You are not in the profit stage. Okay, and I would argue you're probably still in the startup phase if you're not able to pay yourself anything. Okay, so are you able to pay yourself a reasonable salary, one that is able to pay you for the seats that you sit in, to where you're not pulling additional money out of the business to pay your living expenses, and also able to address the tax needs of the owners as well, or the tax exposure of the owners as well. Next is monitoring your financing cost. And your financing costs are going beyond just the interest that's on a loan or on credit cards, but also those credit and collection costs as well. So what is it costing you to collect monies from your clients or from your customers? Those need to be monitored. Early on, you're going to monitor those a little bit more frequently. As your business grows, it's going to give you some leverage. So the stronger that your business is from a profitability standpoint, from a balance sheet standpoint especially, as your assets become greater than your liabilities, and your equity position in your company grows and strengthens, you're going to have more of a position to be able to use as leverage to be able to decrease the amount of interest that you're paying, and also to be able to go to those merchants that you use, for example, and use that as leverage to be able to decrease your cost cost as it relates to what it's costing you, the business, to be able to collect your revenue from a client. And so you're going to want to monitor that. For some businesses, depending on the type of business that you have, you may be doing this on a quarterly basis. For others, it may be on an annual basis, but you do want to make sure that you're monitoring these costs. Next is a good understanding, number 7, a good understanding of your average revenue and profit per customer. So you're going to go through and you're going to want to identify what customers are most profitable to us. Sometimes this takes a little bit of work. And I don't mean X customer, Y customer, Z customer, but the type of customer that you're servicing. For some businesses, it does make sense to look at it on a customer by customer basis. But I think for most businesses, you're going to want to kind of break those customer types down to see what customer type is bringing you the most revenue, is most profitable to your business. So your average revenue and profit per customer or per customer type, and then lastly, the average revenue and profit per product or service offering. And so as in my accounting firm, we're in a position to where we're actually going to be scaling dramatically here over the coming months, and have had an opportunity come our way that's really going to truly allow for our business to grow in a healthy way. And as we're going through this particular process, we are looking and we're analyzing what type of service is going to provide us the greatest amount of revenue. As I look back, I can look into my business as it is currently and determine this is the type of this is the type of service offering that's going to bring us the greatest amount of revenue. And so it may be advisory on average on this type of a customer, but in advisory, I should expect this much profitability, whether it's per hour or per customer or per engagement. And then maybe a tax, depending on what level of revenue, I should expect this percentage. I am going to use this as a decision-making tool. So as I go through, and as my business, and I think as most businesses grow, they realize that there are certain types of customers, there are certain types of products or services that essentially they're going to either stop offering, or they're going to essentially sell off to somebody else and allow for somebody else to take that on. That way you can really get focused on the true niche of your business, to where in those areas which are going to be most profitable. And then as you go through and you begin to expand your business, you can really know, where do I need to focus my energy? Where do I need to focus my those profits that I've accrued to be able to develop within that particular within that customer type or within that service offering to strengthen it. To be able to grow our people within that particular area of my business, and then also maybe bring alongside some complementary products or services that also services that ideal customer that we have that's going to be most profitable to us, so we can bring the most value to that customer, and then in turn also increase the profitability of our business. Hopefully this particular podcast brought you some value. I would encourage you, if you haven't already, please leave us a review, and then also subscribe to the Belk on Business podcast. Thank you once again. This is Josh Belk. Have a wonderful day.